Hi guys, Adam Hebener here, CEO of Modern Mortgage. This is today's Modern Minute, and in this Modern Minute, I want to spend some time talking about some important data that's been showing up, and more important than just simply letting you know what the data is, I want to think it through with you so that we can begin to apply. As you guys know, my focus in sharing this kind of macroeconomic and sometimes microeconomic information with you is so that you can understand how others are behaving. At the end of the day, really what we're talking about when we're talking through economics is how others in our country are behaving and what that might portend for what's coming or what it might indicate for how we should be behaving. And so that's really what our goal always is. And so two big things I want to share with you. The first is that we are seeing a slight drop in mortgage applications. In fact, mortgage applications are down 3.3%. Now, why is that important? Well, here's why it's important. It's important because it's a direct result of a new tax that the government created on refinances. Now, you may not normally hear this talked about as a tax, but a tax is exactly what it is. What happens now is that good old Mark Calabria, the guy I've shared with you in the past who heads up FHFA, who created that very onerous process for forbearance that almost took the secondary market of the mortgage industry out completely, is kind of back at it again. And so what he's saying is, hey, there's lots of refinances happening. Let's see if we can create some profit taking for the government. At a time like this, kind of frustrating that he would be thinking that way, but what he's done is add a 0.5%, that's 0.5%, what's called a loan level price adjustment. So what it does is it acts like kind of an interest rate underneath the interest rate. It makes all the rates go up effectively 0.5% in the way that they're delivered. So what happens is the mortgage market creates the normal interest rate, whatever interest rate that is. It's highly influenced by the Fed, of course, because the Fed is buying all of these and creating a kind of demand, or arguably a demand. It looks like demand to the bond market, and that makes the price of bonds go down because there's lots and lots and lots of buyers out there, or so-called. That's the role the Fed is playing. But when that happens, Mark Calabria sees, hey, there's lots and lots of Americans refinancing their homes. Let's slow that down a little bit, see if we can take a little bit of cream off the top. And so he's added a 0.5% fee. Well, there's very little more frustrating than to see the policies kind of going back and forth at war here. You've got the Fed trying to get as much mortgage stimulation as you can, and now you've got one of the offices of the government trying to take some cream off the top of that. So very frustrating to watch that happen. A more cogent approach would be useful, interesting to observe, but we don't expect to see that anytime soon. What's interesting about it is actually the way that it affects demand. So it is not on purchase mortgages. So those purchase mortgages are actually, if we measure them year over year, they're up 1%. That means there's 1% more people purchasing homes this year than the same time last year. And so you can see that that remains unaffected, if not growing. The demand for purchasing homes remains as strong as ever and growing. Refinance demand, still quite strong, don't get me wrong. It still makes up a huge percentage of most of the transactions in America right now. But it's down substantially as a result of that tax. It was higher, almost double what it used to be, and now it's about 35% higher than it used to be. So still higher, but substantially staunched. And what that tells you is taxes affect demand. Now you can see that in this data. You're going to need to remember that as I share more of the complexities that are kind of coming our way. We're going to be talking about some of the ways that the government is approaching this crisis in future Modern Minutes, but I want you to take that principle so that we can explain it more quickly next time. And that is simply that taxes affect demand. The higher the taxes go, the higher the cost of anything, the lower the demand for that item will be. And taxes have the capacity to increase cost. So be thinking about that. It's a frustrating thing. I don't think there's really much to do with it except to tell you this. If you're waiting for interest rates to go lower, again, we're going to continue to tell you, not a smart move. You have to take them while you can get them. Now, this doesn't mean that we expect they're going to evaporate anytime soon, but there are lots and lots of forces against these lower rates. There are as well, honestly, arguments to keep them low. But the best advice is not what's going to happen in the future. The best advice is how should we act today? Well, how you should act today is you should take advantage of lower interest rates. If you can benefit from an interest rate in the low threes, you need to take advantage of that now, because it's still in the low threes despite Calabria's 0.5% increase. So that tells you where it should be. It should be probably high twos right now, and that's what frustrates us. But in any case, know that piece of information. When we started, I told you there was going to be two things I wanted to cover. The first is this, what I've just shared with you. The second is all of what I'm seeing in the data. I've been combing through the data of delinquencies and seeing some interesting things. So I told you in the last Modern Minute that we were expecting delinquencies to rise, but that I don't expect that to be hitting real estate prices. And I know that sounds a little counterintuitive. I want to report back to you now that as a result of all that deep dive, indeed, what we've seen is a very substantial increase in delinquencies, and importantly, in severe delinquencies. So from 30 days late to 90 days late, we're seeing increases all across the board. Now, rather than give you all the little details of the data, let me just share this overarching principle with you. There are currently 8.22% of all mortgages are in delinquency. What that means is 8% of all mortgages, FHAs, Fannie Mae's, Freddie Mac's, jumbo loans, every kind of loan, 8% of them are in pretty big trouble. That's 1 in 12. So that's a pretty substantial number. We haven't seen a number that high since the financial crisis of 2008 and 9. Now, it was higher in 2008 and 9 than it is now, but this is certainly the highest it's been, and this is very quickly approaching that delinquency level. Now, in 2008 and 9, that delinquency level meant that you are going to have a crash in real estate. So you might be asking me, well, why do you say there's probably not a crash in real estate coming? Well, only because of what the data continues to communicate to us. So consider these things. In 2008 and 9, most folks did not have much equity. So when they became delinquent, there wasn't a whole lot of value in the property because so many of those buyers had purchased with low or no down payment. And because of that, there just wasn't time for them to build a lot of equity in their homes. So when delinquencies began and times got tough, their homes immediately went underwater, and it just wasn't worth it emotionally for them to try to keep those properties. Now, that's not to say some didn't fight tooth and nail. Many people fought tooth and nail to keep their homes and just couldn't. But there were also a lot of folks who just simply said this isn't worth it, and they made kind of a business decision to let their home go. Now, things are different for two big reasons. Number one, there is a lot of equity. So even though someone might be late on their payment, they're carrying $20 and $50 and $80 and $100 and sometimes $200,000 in equity. Because of all that equity they're carrying, they are not willing to let their homes go. So they're very motivated to try to stay in. They're doing all they can, and a large percentage of that 8.22% delinquency rate cohort is fighting to keep their home. So you've got that going for you. They want to stay in the homes they're in. And then secondly, you've got quite a much different approach from the government level with how this will be dealt with. That we've shared with you so many times in the past. But the government response is built to try to keep people in their homes. So if you're not having a lot of folks sell their homes in distress, then you're not going to be able to create a precipitous drop. So I'm going to continue to stick to the prediction I've been making since the very beginning of this process, in fact, since last year, which is we do believe there's potential for as much as a 10% retrace in value. But guys, that is not very much. It would look pretty strange on a chart, but I got to tell you, we've appreciated something like 11%, 5.5% across nation to nation, but as much as 11% in some of our neighborhoods. So just in the last year. So that might mean if we had a 10% retrace, you might go back to the value in the best case scenario of what your house was worth last September. So this is not the kind of real estate crisis that we've seen in the past, not so far. And I'm going to continue to share with you what I see in the data. I'm going to continue to walk this process through with you. Now, as I do that, I want to make one final comment, and that is this. I do not believe that the economy is healthy. I don't believe that we're in a good place. I don't think that the actions around us are actions that serve where we're headed. With that said, I'm still giving you a very clear view of what I believe the real estate data is telling us, and that is high demand, government effort to keep people in their homes, and lots of equity mean that we just don't expect to see a big turnover in homes that would exceed maybe a 10% retrace at the worst. What's most likely? Probably a flattening of appreciation where it's no longer doing this and just starts to flatten out. That's probably the most likely outcome of all of this. So when you can couple that kind of a flat real estate market with very, very good interest rates, that probably continues to draw buyers into the market and will continue to make Denver a strong real estate market despite what we're seeing in the real economy at large. So I'm going to continue to comment on that. Would love to hear your thoughts. If you agree or disagree, we want to hear from you. We want to talk it through with you. We want to be compelling and convincing with what we believe, but we also want to hold lightly to these things so that you can continue to help us learn more. So please don't hesitate to email, comment, like, share, and subscribe, and do all that stuff. And we'll look forward to seeing you on the next Modern Minute. Thanks a lot, guys. Have a great day. Bye-bye.